Welcome to Hidden Truths. This is your host, Catherine Oaks, and today we have Josh Barone, who is going to be talking about inflation, stagflation, and the main topic is real talk. Welcome today, Josh. How are you?
Good. How are you doing?
Great. So the headline daily in the media is inflation, inflation, inflation. We see it everywhere. Are there any signs of relief in sight?
There is, not at the gas pump, unfortunately, but there is other places. The PMI numbers, the purchasers index numbers have slowed down. In October, we started seeing this. We thought there would be a purchaser manager strike. And what does that mean? Essentially, that means that people who buy supplies for companies aren't going to buy. And the reason we thought that is just because of the high prices. There's an economic joke, what's the cure for high prices? And the answer to that joke is high prices. As we saw inflation ticking up, we thought that, again, in October of last year, that we would see a strike. Now, it's playing out funny in terms of containers coming through the Port of Los Angeles. So the Port of Los Angeles had the third best month on record for containers coming through. You're saying, Josh, where's this PMI shock? And you're starting to see it show up in the likes of Target, Walmart, Nike, Best Buy. If you're out there looking for a TV, wait a couple months. The prices are kind of come down in those corporations as their inventories are too high. And it's really simple. Your inventories get too high, you don't purchase, and you start discounting. That's a deflationary trend in goods inflation. The other things that we have going for us is rents and housing. There was multifamily starts were at record highs in April of 22. In fact, you have to go back all the way to March of 1973 to see a better number. What does that mean? It means that there's lots of multifamily housings that were started in April. They're about to hit the market. So that should bring rent prices down. Again, that's deflationary, not inflationary. The other thing that the market kind of has going for it is that it's got a really low unemployment rate. In fact, I don't even know, my chart doesn't show a lower unemployment rate in it. I think it goes back to the 60s or 70s. We have really low unemployment, and that's, again, that's a mixed bag, because if you lower the unemployment, people can demand wages, but as you're seeing people having to discount, you'll see layoffs too. We would suspect that number will start to creep up here a little bit. Again, the Fed has a lot of room to play with that. It's really low.
Understood. We also hear the term stagflation daily in the business media. What does that mean really, and is it a threat?
There's stagflation, which is defined as essentially it's inflation and recession. And then there's 70s stagflation, which is inflation and recession and high unemployment. Here's a couple numbers for you. So the inflation in the 70s, in 74, it was 11%. And in 1980, it got up to about 14%. Comparatively, the inflation now is 4.7% this year. And there's a real big difference in the inflation number between here and there. On top of that, you have the employment was 10% roughly in the 70s, and it's 3.6. So there's your high unemployment that you had in the 70s that you don't have now. If you look at the peaks, we're nowhere near the inflation levels or the unemployment levels we had in the 70s. I wouldn't worry about stagflation in the 70s terms so much. Now, do we have inflation and a recession? I would say yes, but again, we're viewing the inflation numbers as rolling over. We don't believe that we're in this stagflationary environment that is being talked about so much.
Understood. In the Great Recession, there was a financial crisis, but the banks did not have enough cash or capital. Is that a threat in today's world?
Bank liquidity isn't a threat in this world. Essentially, banks don't lend the same way they did in 08. And if you look at banks' balance sheets, actually, they have a ton of room to lend. In fact, they have so much room to lend, they don't know what to do with their money. What they do is they give it back to the Fed in this action called a reverse repo. If you look at the reverse repo, I have a chart of it. If you look at the reverse repos, they're well over $2 trillion at this point. It's not been seen before. And it's slightly interesting. So money center banks have too much money. They're giving it back to Fed in the overnights to get a very little bit of interest on it. The other thing we're seeing is the M2 money growth is way down. You don't have velocity of money really picking up. In fact, it's slowing down. That's counter-inflationary. Both those things are counter-inflationary actually, but they lead to there's not a liquidity event that we see in a money center bank to get the Fed to change its direction. Now, shadow banks is where all the private equity lending is. In fact, that's where I see most real estate deals. No. What I don't see is them repricing their deals. We have interest rates coming up in real estate, yet the shadow banks are still trying to borrow from people like me at really low rates, and they haven't reset. They haven't seen prices on their properties reset. We're waiting to see that, if that causes a domino effect and maybe a liquidity event there, but I don't see that as likely.
Most other central banks are hiking interest rates. However, the European central bank seems to be hesitating a little. Is this a problem?
We were talking about liquidity crisis. I want to bring this up because the European Central Bank and the European banks seems to be where there's possibility of crisis. The European Central Bank recently increased its rates. Don't forget the European inflation is super high, above 8%, and because of Russian oil and not being able to get their hands on it. What we saw is interest rates really change over there. In the weaker countries, what we'll call the splinter countries, we'll define those as Italy and Greece. What you've seen is their interest rates on their 10-year notes have really blown out to a high yield, while the rest of the EU has not. You have this announcement of a rate hike, they haven't done it yet. All of a sudden, the rates are blown out on the weaker countries. The ECB came out and said they wouldn't allow those splinter countries to stay in that effect. So while they're trying to raise interest rates, they're going to have to buy back Italian and Greece bonds and then sell other bonds. So we would say they would sell their good bonds, their German bonds. The central bank doesn't really care about the credit quality, but essentially a central bank that has low credit quality because it's buying back its weak country's credit and selling off its strong country's credit. You get this idea that maybe the EU, the monetary union, isn't such a great idea, that some of these countries would be better off having their own economic policy and their own central banks.
Which has been a discussion for a very long time there. What are your thoughts about the Fed's hiking rates at the fastest pace in more than 30 years?
It's very interesting. They are moving quickly, and there's a lot of people who say the Fed has no credibility. If you look at how fast the rates have moved in the market, I would say the very opposite. The Fed has too much credibility. Essentially, they have this thing called the dot plot. They come out every quarter and they give this. Essentially, it's every member's 2-year focus of where interest rates are going to be. What happened is the market, knowing that we're in a slowdown, discounted out 2 years already to the markets. I think it's the biggest move in probably the history of treasuries over a 3-month period. The Fed has a very hawkish view because they're trying to fight inflation, because when people say inflation, what do they think of? They think of the 70s stagflation, and then it's going to become entrenched. And then add QT to that. So QT is quantitative tightening, and you have them pulling reserves out of the market as they're trying to shrink their balance sheet. Hawkish view, quantitative tightening into recession. They've never done that before. They've never raised interest rates into a recession. Again, we're in a recession. The question is how deep. It's a giant game of chicken. And most of the time in this game of chicken, because it's gone on before, you're just waiting for a liquidity problem someplace along the line. We'll see if that comes or not, but it'll be very interesting to watch.
It's a great update and insight on what's happening in the market right now, as people obviously have a lot of questions.
Yeah, of course. So what happens is in QT, you get the opposite effect of QE. Quantitative easing, you get a lot of money go into the market and you get prices being pushed up. With QT, you get the opposite. You get money coming out of the market and prices being pushed down. We're just waiting for the Fed to realize that it's in recession, to come back to the table a little bit, because their dot plots aren't reality. They're in fantasy land. And so once they get out of fantasy land, come back to the table and say, okay, we're going into recession, there's liquidity problems starting to pop up, and then maybe we're not going to tighten as much as we say we are. And then the market will love that and we'll get back to reality. On top of all this stuff, why people bring up stagflation, there is an oil price shock too, and that happened in the 70s. So it makes the comparison really easy. Will they fix the oil crisis? I don't know. I don't think federal gas tax cuts are going to do the trick. I think that's a short-term fix. I don't think it does very much. Reality is that they're going to have to come back to the table and look at the pipelines and look at where they can help find more oil. Because even if you go to EV, you can't do it quick enough. There'll still be a problem between here and there.
But these are great reminders also of the fact that people have to do their own research and really understand for themselves what is going on and get information from experts like you. We encourage everyone to come to the channel on a regular basis and watch those videos and learn for yourself so you can make better decisions. Thank you. It was great today, Josh. Great insight, great information. Again, everyone remember to follow us on social media, to also subscribe to the channel and to share on your network. It was another episode of Hidden Truths, and we will see you next time.